And there are policy lessons one can glean from the importance of these aspects. Some of those are perhaps already work in progress, but there may be others which need more attention.
I think so. I think the public investment is a very good push, and I really hope we can sustain that over the next couple of years. So we have to find fiscal space somehow, whether it's privatization, whether it's tax reform, whether it's rebalancing expenditure to make this public investment push going. I think the financial sector, again, the budget makes a good start by saying we want to privatize 2 public sector banks as a signaling mechanism. I think really important that get carried out. We've spoken at length over the last 2-3 years about the financial system and how risk averse it had become. I would argue that's not a binding constraint today because demand has to pick up. But when demand recovers, it is possible here that the financial system does become a binding constraint to that 7% real GDP growth. So I think that will need a lot of work. We've seen a lot of risk aversion by public sector banks. So I think that's a supply side issue that will need work. And I think it's just starting off by doing what the budget promised will be a good start. And I think the third thing is, trade openness. There's a lot of research on this to find that ultimately, and in a way, it's not surprising because trade openness forces upon you the ingredients of higher productivity growth. It forces firms to reach a critical mass. Larger firms are more productive. It exerts greater competition, which results in higher productivity growth. It forces regulatory policy to be very nimble. So in a way, open economies tend to exhibit these characteristics just to survive in a global marketplace. And I'll just end by tying this back to the very first question you asked about consumption. See, for consumption to sustain, ultimately it has to be driven by income growth, organic income growth. And for income growth, you need high wage growth. And in all else equal, wage growth is a function of productivity growth. So in a way, these are not unrelated concepts. If you can boost productivity growth, wages will go up. When wages go up and incomes go up, that creates the conditions for more sustainable consumption.
As a last question, Sajjid, I'll just circle back to sort of where I started, but link it to policy. Now, we've already discussed the importance of public investment. We know we have a fiscal runway, which perhaps permits some of that. We won't get into the nitty-gritties of the monetary policy side, but what are the policy mistakes to avoid at this stage? Acting too soon, seeing some of these, sort of near-term demand indicators starting to look better. What are the policy mistakes we should stay away from?
I think diagnosing the macro situation becomes very important, which is why we wrote this report to say it will be tempting. And there's always a clamor from the analyst community saying, well, consumption is going to bounce back. We're seeing pockets of private investment. And if we misdiagnose the situation, like the US did in 2009-10, policymakers 10 years later say we tightened fiscal too much too soon, believing that the global economy was bouncing back. So I think the first is not to conflate 3-month, 6-month pickup in consumption with a more durable consumption recovery, not to conflate some pockets of investment in the commodity sector with a more broad-based private investment cycle. And so I think the first issue will be not to over-tighten fiscally too quickly, especially not at the risk of higher public investment. I go on like a broken record. Getting that 6, 8, 12 quarters of public investment by the center and the states. I think the states is as important. Their capital formation is twice as large as the center. So nudging the states and working with them to do that, number one. Number two, I think, we need to stay open. Import tariffs are like export taxes. This is an environment where we'll get a cyclical pickup because of the global recovery, but also COVID has only accelerated this China plus one hedge. Multinational companies are looking for other avenues in the region. We need to capitalize on that. So I think these are, and third, I would say, over the next couple of years, start thinking about where to generate more fiscal resources. The only way that fiscal deficit can go from 7% to 4% is not to hack expenditure, but to find other sources of revenue. On the monetary policy side, I'm going to venture out to say, one, I understand the dilemma the RBI is in. Growth is below your pre-pandemic level. Inflation has been much above.